Welcome back to Vetted VA Live. We are now all the way up to episode 12. So we're about 3 months into this little experiment of coming here every week and talking about important topics that are coming up in the Facebook group, questions that you guys are asking, and having a little bit more of an in-depth forum for experts, moderators, vetted experts around the country to give you in-depth answers to what you're looking for. So I've got three great experts from around the country tonight. We will start to my side here. Rocky Ballore is with Rockwood Mortgage in Michigan, the Detroit Metro. Is that
Yep.
essentially where you're at?
Oh, yeah. Yep. So I'm Rocky Ballore, owner of Rockwood Mortgage. I'm right here in Oakland County, specifically Birmingham, Michigan. It's great to be here.
Awesome. Why don't you tell us a little bit? What we're going to be talking about tonight is, you see in the headlines, if it bleeds, it leads. There's a lot of clickbait, whether it's on YouTube, whether it's in the news. Housing market's going to crash. Housing market's cooling. What comes next for housing? So we're going to go in depth on that. So really, we just kind of like to start. We're lucky that you guys are all in three different parts of the country. What are you seeing in your market just in terms of market temperature? We know 6 months ago, if we go back, everyone was talking about, I can't get an offer accepted, especially a VA offer. What are you seeing in terms of market times, in terms of values, and just in terms of the temperature and the mood of your market there in Michigan?
Yeah. So, the market is still hot. A lot of people think that if a product just doesn't fly off the shelves on day one, it's not hot anymore. Nothing could be further from the truth. We're kind of seeing temperatures cool just a little bit. We are seeing some houses stay on the market just a little bit longer. We're seeing them not necessarily going way above the price point that they started, which, as you guys know, in all the markets around the country, appraisal guarantees, all of these, things that people were offering, waiving inspections and whatnot. You're not seeing as much of it right now in my market, but it's not to say that it doesn't exist. But it's still super hot over here. Yeah.
Got it. So cooling, but not cool by any stretch of the imagination. Is
No,
that pretty fair?
Yeah.
So also, we have Sarah Acevedo. Help me with it, Sarah. I don't want to mess it up. Schwacker in Chicago. So not too far there from the Michigan Metro. You're a realtor in that market, helping lots of buyers and sellers and veterans there. Why don't you give us sort of the same report on your market there in Illinois?
So it's been interesting watching the market unfold in the last several weeks. We were involved in multiple offer situations, like Rocky mentioned, over asking price offers, waiving appraisal gaps, or covering the appraisal gap, I should say. But that was a lot of madness. I think that we're starting to see a bit of a cool down, quite a bit of a cool down. So, for instance, I have a transaction that I'm working on now, and the asking price is 410,000, and realistically they should probably get somewhere between 400 and maybe 405. However, this home has a little bit of deferred maintenance, and the seller is still trying to hold out, thinking that she's going to get much more. So 10 to 15 showings later, she's not getting offers. And that's kind of what's happening here. It depends on the price point. That's obviously really important. Anything lower is probably going to come off the market like a hot cake.
What's the median price point in your market?
I cover a vast area, so it's hard for me to pinpoint it. But I would say somewhere between 300 and 400.
Okay, so it's still an affordable market. Just to put it in context, I'm here in Southern California. Like, we've got entry buyers having to step up to $700,000-800,000 for a single family residence, and I had an entry level buyer buy their first home, $1 million condo, a couple months ago. So it's good to get the perspective of different points around the market, and to see that the same things are impacting everyone in different markets. So with that, Brandy Brickler joining us from Edge Home Finance. She's in Austin, Texas. Austin has been one of the absolute hottest markets. Went in the last 5 years from one of those affordable markets to one of those not nearly as affordable markets. What are you guys seeing in your market, just in terms of any cooling, any change to what's going on in your market?
Yeah, so in the Austin metro area, there's definitely been a little bit of a change, but those price points are still high. And as far as it pertains to, say, VA home loans, those are still a little bit difficult to, get into that market, but not impossible, because Austin is such a big, vast area that, on the outskirts of town, right, it's completely normal. We're so close to San Antonio. We have a big military base because we're right in between Killeen, Texas, and San Antonio. So we have, outskirts areas that still meet the needs of people, but I mean, price points are pretty high.
Got it. And just kind of to close the loop, again, I'm here in Southern California, Huntington Beach, California. I'm a lender. I've definitely seen a change in that our VA and FHA buyers 3-4 months ago, it was going to be a lot of offers before we got one accepted, and possibly even a unique or a challenged property or a relationship that the realtor had that helped them get into that. We haven't had much difficulty, meaning borrowers can go out and write 2 or 3 offers and get a property under contract. I have 2 FHAs and a VA going right now, and it's probably been months since we've had multiple government loans going at the same time. So before we kind of jump into the definition of what is a crash and will one be coming, like one of the things I think we should focus on is, I don't know what you guys were hearing this time last year, but everyone hated that market that was going up 15, 20% a year, 20 offers on a property. Yet here we are to the flip side of it, and the market is cooling in most markets, changing, less offers, but still multiple offers. But this is kind of what everyone wanted. Give me an opportunity, give me a chance to get a home under contract, but it's kind of scaring people right now. You guys, are you feeling that or hearing that from some of your clients, that it's throwing them off or causing them to hesitate a little bit, when it's kind of the cooling in what we wanted to be able to see in the market?
I can definitely say that it's been a seller's market for a really long time, right? Almost as long as I've been in the business, it's been on the favor of the seller, right? And I've been in the business for 9 years. So I think that what's presenting himself is just a little bit of opportunity for it to flip a little bit in favor of the buyers. A little bit of the craziness that was going on doesn't have to happen. Houses are sitting on the market a little bit longer. Sellers' expectations are having to change. And so while it might be scary, I think what's scary is the economic impact of, a recession, rather than what's happening to the housing market specifically.
Absolutely. So let's kind of jump to that question. So the elephant in the room is the housing market going to crash? So before we go around and kind of give everyone's thoughts on that, especially in your unique and local market, we probably should define what a crash is. Sarah, when you have someone asking you about that or talking to you about a potential market crash, what do you think most buyers, VA buyers specifically, think of when they say a crash?
Based on some of the comments that we see in the group, I think that buyers are thinking that they're going to lose all of their equity. The prices of homes are going to drop and they're going to lose money. And, there's no promise here. We don't have crystal balls. We don't know what's happening. But what I can tell you is that in the mid 80s, interest rates were between 18 and 20%. That was simply due to a tax law change that was out of favor for real estate investors. And it caused a real problem in the market. As time has gone on, those interest rates have fallen. When I first started in the business, interest rates were about 8.5%. And at the time, people that had 11s and 12s were running to refinance. It was one huge refinance party. Then they started dropping down to, say, 6%. And oh my God, people were going nuts over 6%. That was now early 2000s, which is part of what caused the market to increase in the early 2000s. Not just that, but the really lax lending laws. So you had the easier financing requirements coupled with lower interest rates causing a real market boom.
So what I was going to say is let's look at that. So we're saying when the media references a crash or the potential of a crash, we have only ever had one nationwide housing crash. You know, Brandy, where you are in Texas, they had a big housing market crash, real estate crash in the 80s when the oil market went bust. We've had them here in California, but on a nationwide basis, we had never had one until 2008. So, Sarah, that's kind of what you were talking about. Why don't you give us that color of what's different today, which is what you were hinting at, between now and 2008. I don't believe, and I don't want to put words in you guys' mouths, I don't believe we're headed towards a crash, because a crash to most people is, say, a 20% or more correction in home prices. So there's a difference between a crash and a correction. And let's sort of frame that conversation in what was the cause of the crash that the entire country experienced in 2009. You were already on that track, Sarah, so sorry for interrupting you, but why don't you fill
That's
out
okay.
some of what was going on?
Well, you had a lot of bad loans that were being written and sold on the secondary market. There was a bit of a stock market effect from that too. There's a movie that I can't think of the name, but it really, The Big Short, or
Yep.
The Short, was
Yep,
that
The
it?
Big Short.
Watch that movie. That movie will really tell you what's going on there. But what happened was you had lenders writing bad loans pretty much and turning a blind eye to them. Well, it caught up to them eventually, and a lot of these loans started going bad. People started foreclosing. There was lots of foreclosures. Little by little, prices came down. Um, not, little by little is an understatement. They went down pretty fast over, I would say, 3 to 4 years. So it was a race to the bottom. Houses would come on the market, and it was, you had to almost guess where you have to price that home in order to get it sold. And before you know it, there's a couple of other price changes, which means now you have to change your price. So it was literally like a race to the bottom. And I think that was scary for a lot of people. People lost their homes, they lost equity, they lost their savings, and truly had to start from scratch.
And think about that. So 2008 to today, it's 14 years. Prime home buying age, first time home buyer age, is about 33, 34 years of age. So those people that are looking to buy now were 20 at the time. And those that are coming behind them, Gen Z, were even younger. They were 15, they were 10. Maybe their parents lost their home or had to kind of white knuckle it through that process. But think about when you're 10 or 15 or 20 years of age, you don't really understand how the housing market it works and what caused that. So why don't we go into that in a little bit more detail? So Rocky, you do loans. What type of loans were being done in 2008 relative to what we have today? The VA loan is a unique one in terms of that it doesn't require a down payment, yet it still has the lowest default rate of any loan. So specifically talking to our VA audience about the strength of the VA loan, but how all loans today vary versus 2008. You want to give us a little walkthrough on that?
Yeah, most definitely. So there are a large amount of loans that didn't exist for a while. We have a couple that have kind of entered the arena recently, as far as like NINAs, NIVAs, SIVAs, like no income verified assets, no income, no assets, what we would call, non-QM. But they're not being written with the veracity that they were in 2008. And they were just being loosey goosey. There was option arms. There was a lot of products that kind of, faulted the market and kind of caused stuff to go awry. But as far as now, just simple conventional, VA, USDA, we still have a lot of those products. One that's tried and true is the VA loan. You know what I mean? So you never heard anybody say anything about the VA loan causing the housing crash,
Absolutely, because it's one of the best underwritten loans. And one of the things that's unique about the VA loan is the residual income calculation. So it doesn't matter if you meet all the other guidelines. If they run through that residual income and say, hey, your family doesn't have enough to live once you're done with paying everything, they're not going to give you the loan. But I had a unique view. I worked at a direct lender. I'm a broker now. Back in 2008, 2007, 2006, I was at a direct lender. And kind of when we knew things were going sideways, to sort of kind of close the loop on what you were saying, we got to the point where the subprime lenders were coming in and they were offering stated income loans at lower interest rates than Fannie and Freddie rates were. And again, going back, Sarah, what you were saying, the Big Short, they explain why this was all done. They wanted the better loans to put in the pools with the bad loans to sort of offset everything. But you had a market that was completely upside down. There's multiple things that make a file strong, and you can take one of those legs of the stool out, but you can't take three of those legs of the stool out. So we had loans that didn't require down payments, combined with loans to really low credit scores, combined with not having to document your income. That's like a no-legged stool. It was going to fall. It was just a matter of time. So comparing that to today, we talk about how strong the underwriting is on VA loans, but every type of loan. Basically, the laws were rewritten where Rocky was talking about a non-QM or a non-qualifying mortgage. Those loans can be underwritten, but they can't be sold in the same pools. So they have a much higher premium. Where I'm saying we got lenders coming saying, hey, give us subprime loans. We'll pay you better than a Fannie Freddie or an FHA or a VA. You're paying a big premium for that now. So it's not a big part of the market. 98% of loans, 95% of loans are underwritten to solid guidelines. But let's sort of talk a little bit about why it is that this is a hot topic. Why are people in the Vetted VA Forum? Why are home buyers around the country even looking at this? Brandy, your market is kind of the poster child for this, of going from an affordable market to an unaffordable market. So really, that's what this issue comes down to. People look around and go, there's no affordability left, so they have to come down. There has to be a crash. What are your thoughts on that?
Well, I mean, I think a lot of our market went really crazy because I just also moved here to the Texas area from Hawaii. So my perspective on what was affordable was much different than probably people who live in Texas. And what we did get was an influx of buyers from, California per se. We'll always like to talk about the California buyers coming in. And the reality is that if they were selling their houses for, XYZ amount of dollars in California, which was probably as much as you could buy a cash house here, in Austin, Texas, or put a significant down payment to where the mortgage payment wasn't much different, then it made sense for them, right? And so that kind of drives up the market. I mean, I can say it for myself. When I came here and could find a house that was twice the size and half the price that I would buy in Hawaii, I was like, this is great. Now, that might have been a different perspective for those people who actually live there. And of course, it drove up the market, but also what also has driven the market is just the influx of business that's happening in the area. So when we talk about crashing or will the market change? There were some areas of the country back in 2008 that did not see as much of a loss in value just because they had really strong, economic abilities in that area. So I don't really see per se a crash. Another thing that you have to think about is that what's been happening in this market and has also sort of driven up prices is hedge fund buyers. So hedge funds are putting their money in this market, and that should be a good indicator that we're not looking for a crash. Hedge fund managers are not making mistakes by putting their money in this market.
And that's a really interesting point. Before we came on, Rocky and I were talking about that. We don't see it so much in Southern California because our prices are so high relative to our rents. But Rocky, you were saying that is something that is prevalent in your market, that you're seeing actual home buyers have to compete with foreign investment groups and hedge funds here in the U.S.?
Absolutely. I mean, Canada was kind of on to the right track in banning these foreign direct investments or corporations from buying properties now. And if you look at, there's lots of data as far as Detroit proper getting bought up by private equity firms from Australian billionaires, Chinese billionaires. Doesn't matter where they're from. The fact is that there's corporations buying these large parcels because they know, they've done research and they see that it's going to be worth a lot of money in the future. And it's happening, unfortunately. And like you were saying too, Josh, once they leave, they're not coming back on the open market for a long time,
Yeah, and people sometimes don't realize in the context of this conversation, it's not all that important because if you're watching here, you're probably saying, I want to get in the market. I want to buy. I don't really care why hedge funds or big investment groups are buying homes, but it's important to know why. If you look, interest rates have been really, really low. So even when we say interest rates are high, a 10-year treasury today will get you 3.25, 3.3, wherever we ended it today. That's not a lot of money. Now, if you're a hedge fund and you say, we've got a bunch of money we have to put to work, we can buy a house and it will rent and it'll give us a yield, depending on where you are in the country, 5, 6, 7% yield to just park the money. But you also have seen home values go through the roof. So they're getting appreciation on this asset, and you can start to look at it, go, the numbers make sense for them. So it's not something that's likely to be unwound anytime soon, because even if the appreciation tails off, they're getting a really good yield on that money. And if they sold those homes, they've got tax issues to deal with, and then they have to put that money to work. So they'd have to be pretty convinced that numbers are going to get drastically worse before they start unloading these homes. If you guys remember, back in 2009, 2010, the plan for these hedge funds was, hey, homes are super cheap and we can buy them, and then let's ride the market up for 5, 6, 7 years, and then we'll make a big windfall profit. And then they looked up, and somewhere along the line, the numbers changed from, hey, we don't have the eye on the prize of a big windfall profit. Let's just keep, shearing the sheep month after month after month. So although we don't see it in our market, it's out there, and I don't see it being likely to go away. Sarah, is it something that you see much in the Illinois market?
I think that you're absolutely right. There was a lot of real estate bought on speculation during right before the market crashed before. And so what we saw a lot of were even ghost towns, some neighborhoods that were owned primarily by investors who gave the properties up, went into foreclosure, and you had very few owner occupied homes. So it does damage, or I should say, some neighborhoods were blighted just simply because of that. On the flip side, there were neighborhoods like, for instance, on the south side of Chicago, there were neighborhoods that it was just sad to drive through, simply because in one block, there may have been a combined number of boarded up homes along with vacant lots. And we're talking 10 to 15 properties in one block.
I think that brings up a good opportunity for exit strategy, or for like what people who are buying in this market, like what do they do next?
And it's crazy. So Rocky, in your market, it's something like we have every big state has their big cities, and you have inner city stuff, but Chicago, Detroit, Cleveland, you had areas that, like, literally in 2008, 2009, they couldn't give houses away. And even those areas have recovered to a large degree and returned lots of money to investors. I was telling you guys, my barber is from Detroit. He bought 2 homes in Detroit when his grandmother passed away. She left him like $30,000 or $40,000. He bought 2 houses. One was $10,000, one was $12,000. Put about $15,000 into fixing them up because they weren't the nicest, but that was sort of that blight that we were talking about. And Rocky, you're saying in Detroit that you've got billionaires coming in that are buying up entire blocks and changing the market. So in the context again of our conversation here of is there a bubble and what does it mean, we're talking about affordability. So home prices have gone up a bunch. One of the elements there is investors coming in, whether they're mom and pop investors or these big institutional investors. We also have demographics. We talked about first-time buyers. Prime buying age for a first-time buyer is 33, 34, and we're still like 2 years away from the millennial peak of that group. So a lot of those people still want to get in the market. Is that what you're seeing? I mean, we have an affordability issue because prices are higher, but what are you guys seeing in your markets in terms of that first-time buyer? Are they still wanting to get into the market, and what is that doing in terms of demand-wise for you guys?
If I can just mention on this, I think that there's an entire paradigm shift when it comes to people and how they're buying and how they're using their homes. So we're seeing more multi-generational homes where it may not be affordable to live on your own anymore. So roommates for renting situations excuse me,
House
becomes
hacking.
ideal.
Yeah.
Or house hacking. But you also have, cousins living with aunts and uncles, living with grandparents, and that sort of thing. Everyone's kind of getting together to get by. Um, yeah, does that answer your question?
Absolutely. So why don't we talk a little bit about the sort of the last elephant in the room? Affordability is really comprised of two things. What's the price of the house? And then what does it cost to finance it? Especially with VA loans where most people put zero down. We do have a lot of VA buyers that do put some down, but the majority are done with zero down. So the interest rate there comes into play. Why don't we talk a little bit about where we've been? Like Rocky, where were rates in December, and how does that compare to today? That was less than 6 months ago, but at Christmas time,
No,
what type
yeah.
of
I mean,
rates?
it was, yeah, night and day. Yeah, absolutely. And there's no doubt about it that it has an effect on people's ability to qualify for loans, and not only that, psychologically, right? They're like, this is way higher than what I gauged it was going to be, and I don't think I'm ready for this. And a lot of times, that's when an amazing realtor makes the difference, because an amazing realtor will not just push them towards buying the house, they will display all of the options. And 7 years from now, you're not going to have this rate, most likely. This is probably going to be a short-term thing, but you will have this home. Historical analysis shows us that this is going to be a great investment over time. Maybe not the next year for sure, but over the next 10 years, it'll definitely be one. So I found those amazing realtors to make all the difference in the world.
No, it's really important. And we talk, if you look, we were talking about a thread over the weekend that got posted in the forum that has over like 850, almost 900 comments now. And a lot of the advice that moderators just like us were giving is build your team. It is really important that you have both a really good professional realtor and a good lender on your side, and that they are working together. The VA transaction that I have right now, it's with an agent I've never worked with before, but 2 minutes on the phone, you're like, this dude knows what he's talking about. And that client had worked with 3 realtors before that. It had never gotten anything under contract. Now, some of it, we talked, the market has cooled a little bit, so it got a little bit easier, but the goofballs that were calling me before relative to a professional, he got her in a house in like 2 weekends of looking when she had spent the first half of the year. So that team of putting the whole thing together is really important, but I would say it's very important that we work together. So sort of along that topic, we've got a couple of good questions here that have popped up from the audience. As we're seeing the market shift a little bit, downshift a little bit and cool, can a VA offer be competitive when you're up against an investor or a cash offer? Why don't we lead that off, Sarah? You're the realtor. You're the one out presenting those offers. What are you seeing in your market in terms of VA offers going up against investors? And are you still seeing that in the current market?
I think that there's still some level of trickiness to it. The market has cooled off, but it is by no means a buyer's market. It's gotten a little easier, a little less competitive, and buyers absolutely do have a chance. So I want to give you hope if you've been thinking about getting into the market, or if you're on the fence and thinking, maybe I'm just going to give up. With real estate, you have to look at things in the long term. Okay. So if we stop and look at interest rates from, say, December till today in a 6-month period, yes, it's scary. From 2.25% to 6.5%, and am I hearing rumblings of 7 out there? People were qualifying at 7 to just preempt the potential that interest rates will go that high. So yes, it looks like a huge jump, and it looks like the sky is falling when you look at things in terms of the small time frame. However, when you look at them long term, as before I was saying, it used to be in 18-20% in the mid 80s. But even from the early 2000s, when interest rates were at 8-7% to going down to 2%, and now slowly coming back up, it's still not horrible at 6%. Like, that's what's normal. And I think that that's what people need to understand. 6% is actually a normal, healthy interest rate in the market. While we may not like it in our pocketbook because we became accustomed to seeing the 2.5s and 3%, the reality is that was not sustainable. And truly, it lasted way too long. The market suffered, the people suffered, the prices of homes have suffered in a way that they are increased. But it wasn't sustainable. We can all look at this. You don't have to be a real estate professional to say, how can I ever buy a home if every time I submit an offer, it has to be $40,000 over asking price. It's not sustainable. And in some markets, we even heard of $100,000 over asking price and other crazy things that were going on behind the scenes. So this is healthy. Go ahead and get into the market. If you need to buy a home, if that's what your life circumstances are, buy a home. And maybe we should even talk about risk tolerance versus people who are risk averse. If you are not into risk, this isn't the market for you to get into. There's all kinds of risk. We don't know where it's going to go. There's no crystal ball, and we can't sugarcoat it either. I'm not going to lie to you. If I don't know, I'm just going to go ahead and say I don't know and try to find the answer for you versus coming here and, painting a pretty picture that's going to set you up for failure.
I'm sure all of us have scenarios of clients that we talked to in 2019, early 2020, or I have a client that she qualified. Again, our numbers are wacky here in Southern California. First time buyer, her and her boyfriend were looking at 950. COVID jumps off and they backed off their 401k. I remember the stock market drops 20%. They're like, I don't have money in my 401k. I was doing a 401k loan. They didn't do anything. Now, I kid you not, in our market, that $950,000 house is $1.6 million now. They don't qualify for $1.6 million. They do not qualify. So there is, Sarah, just like you were saying, there's no way to completely insulate yourself from risk. There's risk of action. If they had done something, it could have gone the wrong way. But there's also a risk of inaction. And unfortunately, we have a lot of clients who could have and should have bought and got sort of freaked out. So that's not to say that everyone should jump in the current market, because with affordability low, prices and rates high, there's definitely risk there. But like you said, there's a difference between being risk averse and just knowing what my risk tolerance is and where I want to step in with that. Brandy, how are you dealing with that in conversations with clients? It comes up.
Yeah, no, this is a great conversation, because I had this conversation with one particular client who started shopping in, say, December timeframe, where they were qualified at 2.65, and that was kind of where they were going to be. And then things were still a little bit crazy as far as pricing, right? And so they would haggle a little bit over the price when they really shouldn't have been in the San Antonio market. And then they were absolutely refusing to pay any penny over what they thought the value was, right? It wasn't what it was listed at. They might even bid a little bit lower. And then we finally closed last month, and they closed with a 4.65 interest rate. And the only reason why we had to do that is because we kind of had to come to Jesus like about a month and a half before. And I said, these are the offers that you have been putting over the last 4 months. These are the offers that you have been putting in, and this is the value of the home now, right? If we can just pull the values from there, you can see the market is still increasing. You would have a 2.65 and already have equity in a house had you not been haggling over. But now we're starting to see things a little bit, they're changing a little bit, and which is opening up some opportunities for those people who might have exited the market because rates got a little bit higher.
Absolutely. Why don't we talk a little bit about that, opportunities for buyers in the current marketplace? I spoke yesterday to a potential veteran buyer, wanted to use their VA benefit for the first time. And they're like, cool, we only have about $10,000 to work with. And again, they're looking at a $700,000, $800,000 price range. We need some more than that. But, one of our friends and fellow moderators here, Max Franks, pops up and says, can we talk about closing costs being covered by either lender credits or something that has been completely unheard of for the last 2-3 years, seller credits?
Great question.
Are you guys seeing the opportunity to get seller credits in any of your transactions?
Absolutely. I mean, my last 2 deals, I was able to, get that done for them based on like clear, concise communication. Triple C's having a meeting with the realtor, and they were a warrior, honestly, for their clients, and they got it done. And, you know, it might not be the first house they look at, but if you have that clear objection or objective in mind, you're going to find that house and the sellers that are willing to provide those concessions to be able to pay towards closing costs. Absolutely.
And then I'd like to say, like, let's talk about it. We're probably more in a market in my area, so I can't speak to that in your areas, but where seller credits could be an option because sellers haven't kind of gotten it in their mind to sort of shift. So they might be more willing to offer a credit rather than lower their price. But as far as lender credits go, that's a little tough, right? Because we're already at a high interest rate. And so raising your interest rate a little bit more to get you a seller credit hurts a little bit more than what it used to. Absolutely. Right? So they're not as readily available as they used to be.
That's probably the best point of our entire conversation here, because think about that. We go back when rates were at 2 3/4, you'd be like, well, hey, for 3%, you still have an amazing rate and you're getting a nice big lender credit. And there's no world in which the seller is going to give it to you. So this is the only way you're going to get some money. And now we've gone almost the opposite direction. That with rates so high, like people are like, I can't go any higher. I don't qualify any higher. I can't handle a payment any higher. But now we're getting to the point where the sellers can help us with that. And Rocky, to your point, I hate to sound like we're just saying how important it is over and over for the realtor and the loan officer to work together. But I have one where we got a $9,500 credit on a $225,000 property here. And awesome. If it weren't for that realtor, like you said, just being a warrior and going to bat and explaining to the sellers, hey, you already had one price cut on this. Let's find a number here. We know this property is going to appraise, but let's find a number here where you're not necessarily cutting your price, but you're covering the costs here. So it is unique because we've got seller concessions in lieu of repairs. Like, we don't want to do $3,000 of repairs. Here's a credit for the last couple of years. But I would say legit in a contract that a realtor negotiated, it had been at least 2 years since I had seen any type of seller credit. And we've had 1 or 2 here recently. So it's interesting that you guys are seeing it in all your markets.
Well. Seller credits are definitely coming back.
What is there anything that you guys feel like we haven't covered so far that buyers should be considering in this market in terms of measuring the risk to them, measuring the opportunities that they may not have available to them, and if it makes sense for them to enter into this market? You guys have any thoughts that we haven't covered yet?
I have been seeing Tidewater a little bit more as the shift is happening, like things have not caught up. And so I have seen that on a few transactions, which is where the value comes in below the agreed upon sales price. And that's another reason why it's important for you to have a knowledgeable realtor and a knowledgeable, VA lender who knows exactly what to do in those situations.
Absolutely. And if you're interested and you want to learn more about that, one of the first episodes we did, we kind of went into the VA appraisal process and why it is awesome and far and away the most flexible versus conventional loans, FHA loans, jumbo loans, where you have to rebut an appraisal that's already delivered to you. You have to tell the appraiser, hey, you're wrong. Here's why I think you're wrong. Fix this for me. Yep. In Tidewater, it's much more collaborative. So again, we went with 3 other of our expert mods that went through for an hour and explained how all that can benefit you if you're interested and have any thoughts on that. I had a question for you guys and I can't remember what it was. Rocky, did you have any other thoughts that we haven't covered so far?
No, I think we covered everything pretty perfectly. But as far as this market goes, guys, don't let this keep you from, completing your home ownership journey. If you look at everything, look at it over a large period of time. Don't let people tell you that this is a housing bubble. Housing bubbles pop. Well, no. How come housing bubbles can inflate, but they can't deflate a little bit? It doesn't mean it's just going to pop. So you have to pay attention to some of these things. Obviously, like Josh was saying earlier, some of these news aggregation sites, that's what they do. It's clickbait. They're just trying to get you to click on their paid ads or, get more views. Look at everything based on the info provided to you and don't worry about, just the doom and gloom.
Talk to a professional, get real answers.
Yeah.
I have to agree. I think that when you're in the market, it can be emotionally exhausting, especially when you look at property, you fall in love with it, you want it, you make the offer doesn't get accepted. It's a bit of a heartbreak. You have to pick yourself up and get back out there and look again. After doing that several times, I think it gets to be hard. So if you need to pull back from the market and take a bit of a break, by all means do that, but keep an eye on the market, stay in it. It is a moving market and things happen every single day that can change. Interest rates can go up, they can go down. Um, New properties come on the market. Every property is different. Every buyer or seller is different.
Yeah.
So I think that the trick to all of this is marrying all of those scenarios, the buyers with the sellers, with the timing, with, all of the stars have to be aligned, right?
Great point.
But don't back out of it completely. We all need something to live. If you're not in the market, you are not affected by the market. And what I mean by that is, let's say that you have a property that you may be thinking about selling. Well, you should have probably sold in the last couple of years and made a pretty penny and walked away. That would have been the perfect time. Is today a good time? Sure, it's still a good time to sell. Sellers are getting their prices. They're still selling for top dollar. That hasn't gone away. Do prices constrict a little bit? And does the market correct itself? Yes, it does. And that's okay too. It's bound to happen. And if you happen to buy during one of those cycles, good for you. Now you're set up for an increase down the line. You see the housing market start to crash, don't get in as a seller. Don't get in. If your life affords you the ability to stay where you are and stay put and ride the market out, do that, because again, you're not affected if you're not in it.
Well, Sarah, you talked about something really important. Is a story that I like to tell is one of my wife's best friends. Her parents came to me in like 2006 and they wanted to buy a house. They had rented for almost 15 years. They had calculated back of the napkin. They'd paid like $215,000 in rent. And they're like, this is stupid. We're not going to rent anymore. We're buying a house. And I said, there's some clear signs here that we're seeing some cracks in the market. And we had the crazy loans, all the bad and negative stuff we talked about. I said, are you sure you want to do this? She said, here's the deal. I've saved the money for the down payment. I'm going to do a 30-year fixed rate, and this is the house we are going to die in. So I am not moving. I don't care. So sure enough, they bought within probably $30,000 of the peak. So within 5% of the peak on a $600-something house. That house went down to about $300,000 at the bottom of the market. And today it's about $1.1 million. And they've paid their $600,000 mortgage, less their down payment, down to a couple $100,000. They're sitting on close to $1 million equity. So again, if those numbers sound crazy to you, we're in Southern California, but they never cared. They got to refinance a couple times as interest rates came down. So they started at a 6% rate. They're down on a 2-something rate in this tiny little loan. And it's the greatest thing they ever did. And they literally bought at the worst time ever. That doesn't mean that I suggest you try to time the market and buy in at the absolute worst time ever. But make sure you have that long time horizon. If you're not sure where life is going to take you and you may be somewhere else 2, 4, 5 years down the line. Now, again, we're talking to a group of veterans here. If you are going to get moved and it's not your choice, it changes the calculus here. Mm-hmm. So it is something that you definitely, when you're going back and talking about your risk tolerance, your risk aversion, you want to think about that because it's definitely a question. Some of these markets could correct. And if you're using a VA loan without a down payment, the risk can be a little bit higher. So work with your professional team to go through that exact equation that Sarah just worked through of saying, think of your timeline, think of where you're at, and is now the right time. You know, we heard it said all the way through to the last bubble, oh, it's always a great time to buy a home. It's always good to own a home. It may not be the best entry point. So make sure you're working with pros who can guide and advise you on that. So before we
was perfect.
Exactly.
It truly is crazy that I have that example because we had that conversation. I'm like, this is crazy that they're buying, but from 2006, 16 years later, they look like geniuses. I'm the dummy for trying to talk them out of buying a house, but it's important that you run the numbers and know what you're looking at. But we do have another good question here. Someone who was listening to the conversation about the seller credit says, are seller credits only a thing at some price points, like lower price points? Do you guys
not
see
at
it?
all. No,
Okay.
I mean, it's all across the board, 100%. Yeah,
we're seeing them at all price points. I mean, we're seeing them, purchasing a house that's 500,000, whatever, they're available in these markets. It's coming back. It's a thing.
I talked to a friend who's a lender, again, Southern California, crazy numbers, $1.4 million home. They got a 3% concession over the weekend, $42,000.
That's amazing.
So they used $14,000 to pay the closing costs. They used $28,000 to buy the rate down because the buyer just wasn't comfortable with where the payment was, and they got more than 0.5% lower in the interest rate. And when you sit and pencil it out, a lot of times this isn't just. We think in terms of, is it a buyer's market or is it a seller's market? Like this is a zero-sum game. Well, in a perfect world, we can find a middle ground that works for everyone. Basically, that $42,000 credit, the seller was willing to give it because to get the buyer the payment they were comfortable with would have required a $95,000 price reduction on that house.
Oh, wow.
Obviously, the seller doesn't want any part of that. So relative to a $95,000 price reduction, the $42,000 seller credit sounds pretty good. And the numbers work similarly at every price point. A $300,000 house with a $9,000 credit versus a $25,000 price reduction. Those numbers work. So it's important that you're working with experts that know the numbers, can run through and tell you, hey, here's your options, versus going in and saying, let's try to cut this person to a rock bottom price. Let's find a way to get you to a payment that you're most comfortable with as well.
I'm seeing that as a strategy in hearing a lot of chatter about real estate agents structuring, offers that way. Which is why it's, there's some new opportunity out there that maybe someone who left the market can come back in, right? Because, these new opportunities out there, and it's shifting quickly. We're seeing new things, new strategies, cash offers or, ways that you can make cash offers and things like that on the table. But these things are coming so fast that if you just exit the market and you're, just quit looking altogether, you might miss what could be the best time to buy.
That's right. It's happening in just a matter of weeks. We're seeing drastic changes.
Absolutely. Just make sure, guys, if you do have a situation where you guys are using seller concessions, just make sure you talk through a good plan B game plan. If the appraisal comes in lower, that's the first thing a lot of sellers will want to get rid of. Because they're thinking, hey, I'm getting less money for this home. I'm not going to give you concessions. So and that's not every seller, but talk through those different pain points with your realtor and your loan officer.
The team is in.
One of the things that we didn't talk about, and it's kind of important to take note of, yes, prices are higher and interest rates are higher. The price is permanent. You don't ever get to go back and 5 years later renegotiate the price. Correct. But you always have the opportunity to refinance. And we didn't go too deep on what comes next for the economy. Are we headed towards a recession? Recessions are deflationary. Interest rates always drop during a recession. So it's like...
Oh, sorry.
No, I was going to say, and it's likely that we're headed there.
Absolutely.
So does that mean that rates are going to go back to 2.75 or 2.5? Probably not. But most of your clients that are buying with a 5 1/4 or bought it at 4 1/2, if they can get a 4 or 3 3/4, they're going to be happy with that. Yep. So remember, your price is permanent. When you buy the house, you're fixing the price forever, but the interest rate is not. Rates are not going to be this high forever. Again, going back to Sarah said, we don't have crystal balls, but we would like to think that we've been around long enough that over the last 40 years, we've had about 7 or 8 different refinance markets. So about every 3, 4, 5 years, that opportunity comes along. So if the payment makes sense for you in today's market, you're probably going to have an opportunity to get a lower rate in the future. And inflation, one of the positives to inflation is over time, 10 years from now, you're going to be making more money. And with that fixed rate, the payment is going to be similar. So these are the questions and conversations you should be having with your team of pros like Brandy, like Rocky, like Sarah, who are hopefully working together to get you exactly what you need. So we're going on close to an hour here, guys. I think we've covered the topic pretty well, but give you guys any chance at closing thoughts. Anything you want to leave the viewers with here before we sign off?
Utilize the group, guys. This group is filled with tons and tons of information, and there's a lot of people that utilize it on a daily basis. We're here to help. We make it our second full-time job to be here for you guys, and we're a wealth of knowledge. I'm not tooting my own horn. I'm actually tooting the horn of all these amazing people
as a collective.
Yeah.
Agreed. Yeah, I know 100%.
No, what the group members don't see is there's a private group for us moderators, and there are things that come up regularly in those groups that I'm like, how does someone know this? That is a 1 in a million thing that would happen, yet someone in our group has that knowledge of exactly how to handle it. So Rocky, it's not tooting your own horn, it's tooting the horn of the collective group.
Absolutely.
That it is mind-boggling what is known by everyone in this group collectively.
It's amazing.
We're truly here to serve veterans, active duty members, spouses of members. We're here to serve. We want to make ourselves available to you. If you're coming across any kind of issues, obviously search the group first, but we'll do what we can to get answers for you. That's what we're here for. I think that we're happy to do it. At least I can speak for myself. I'm happy to help in any capacity that I can.
Absolutely.
And, we don't want you to lose hope. It's not that bad out there.
Yeah, no, I agree 100%. If the people watching could see like the massive operation that goes on behind to make all this happen, to make sure that you have the best knowledge that you can get, no matter who you're using for a lender or a realtor, doesn't matter. You're always getting the best information, and it's just a massive behind the scenes, and we love it.
Absolutely. So again, hey, I appreciate you guys for showing up, sharing your expertise, giving us a portion of your evening. We covered some topics I didn't think we would go into that were really good and really valuable. I'm lucky as getting to host here, getting to hear the insights from everyone around the country. So if you're a member of the group and you're in the market, wanting to be in the market, we're here every Tuesday, 5 o'clock Pacific. So what does that make it? 7 Central, 8 Eastern. Just mark it on your calendar. If you can't catch it, come back and review it, because there's a wealth of knowledge that you guys share every week. So again, thanks to the three of you. Thanks for those of you watching, and we'll see you next week.
Thank you.
See you guys.
Thanks, Josh.
Bye.
Thank you.